All right, BADM 307 students, we're going to get on to another new topic, and that's mortgages on land. We're going to do this in abbreviated fashion. You'll be happy to know that. The former textbook went into incredible depth and law school type stuff, and so I don't use that chapter. So all you'll have to remember for this portion of the course is what I tell you right now. If I find a decent a summary of mortgages, then I'll post it on eLearn, but I doubt it's worth it at this point. Anyway, mortgages, a concept where you want to buy a house, but you do not have enough money to buy the house, so you have a down payment. You make the down payment, and then you go to the bank and you say, I need a mortgage. You get a mortgage, and then you pay the bank off over time. The bank makes lots of interest on this, and so they just love it whatsoever, and if there's a problem, then they can take the land from you, so they're well secured. Banks love them. And we have to live with them. So consequently, it's something that we should know something about. That being said, we don't have to go into it in as much depth as the other textbook. So here goes. Mortgages were granted in medieval times. People that owned land would find that they could not meet the taxes because the king was taxing them heavier and heavier and heavier. And so what they would wind up doing is they would give the king a mortgage on their land. And mortgage comes from the French words mort and gage. Mort meaning dead or passive. Gage means a pledge. So the landowner would mortgage the land to the king, but in those days you had to get off the land. So if you get off the land and you don't have crops or you don't have wood or whatever, how do you pay it back? You had to join the army, and you would make money as a soldier. Unfortunately, generally not enough money to actually pay the mortgage off, and the land would be forfeit to the king. Not a very good system. Anyway, in modern times, it's much better. It's still very difficult, but much better. So a mortgage is a conveyance of an interest in land. And during the time that the bank holds the mortgage on the property, they have legal title. Okay, so you no longer have legal title. You have what's called an equitable title, meaning the right of the mortgagor to redeem the mortgaged land on payment of the debt in full. All right, let's back up. We go to the bank and we say, I want a mortgage. That's really incorrect, okay? You should go to the bank and say, I want to give you a mortgage, okay? Because you are in effect giving a mortgage to the bank. They're just lending you money. So you are the mortgagor, the person who grants a mortgage as security for a loan. The mortgagee is the bank, the lender who accepts the mortgage as security for the loan. You give the mortgage, but you have the right to redeem, okay, which means a reconveyance of the interest in the land, in other words, ownership, once you've paid off the entire amount of the mortgage. So the fact that you have this right of redemption means you have some equity in the land. Once you've lost the equity, then you've lost the land. Okay. So on slide 124, I have a lot owned by Merdley Gertson. Merdley holds legal title, okay, when he has no mortgage. But then he needs money, so he goes to the bank, and suddenly the bank holds legal title. Merdley holds equitable title. Okay, the equitable title means the right to redeem. So if you put down $50,000 and you got a mortgage from the bank, and then slowly you're paying it off, you're paying it off, and you're paying it off, you can build up the equity in the property up to $200,000, let's say. The property is worth $1 million. That means you have a mortgage for $800,000, but you do have $200,000 worth of equity in the property. You can actually go to the bank and say, I would like to mortgage my equitable interest. So the bank holds a first mortgage, the first charge on the property, and then they grant you a second mortgage. Okay? Now they won't grant you $200,000 because they still want some equity in there, so that when they have to foreclose, should they have to foreclose, they have this this money cushion there. Okay, so the right to foreclose was something that was brought in by statute. A mortgage allows the mortgagee to kick the mortgagor out of the property for non-payment. Okay, back in the dirty 30s, meaning the 1930s, when we had our depression, a lot of people had mortgages on their homes and on their farms and couldn't pay, and this is where the banks got the really sort of bad reputation of the black hat, the mustache, and the cape, kicking the husband and the kids and the wife out into the snow and taking the property, because that's what they were doing. During the Depression, the banks held legal title to a huge amount of land. Well, eventually the courts decided, or the legislature decided, we should have a statute that allowed for a foreclosure proceeding, where the bank then says, okay, we're going to foreclose on you unless and take the property unless you pay with us within a certain period of time. So all mortgages have an acceleration clause. Some of you who had me as an instructor for BADM 107 will remember that in my contract problem that I got people to draft, there was always a right of people to come onto property and seize assets that they held for security, but also to demand all payments that were due and owing to be due and owing at the right off the bat, rather than having to wait until all the payments defaulted. This is the acceleration clause. So they say, okay, now all the payments, or all the payments are due, and the interest that you owe is building up, and the interest gets added on to the payments that are due, and interest begins to be calculated on the payments, overdue payments plus the overdue interest, and so consequently you have this this sort of exponential growth in what you owe, and so a lot of times if you're being foreclosed by the banks, it's almost better to quick deed claim the property to them. They can sell it, and then any money that they get in excess of what they're owed comes back to you as the previous owner. The concept of the interest being added on to the principal that's owing and then interest calculated on that is called compound interest. Okay, and the process for foreclosure, and I don't do this, but I have watched it being done in court, is that the person defaults on the loan, and it goes on for 2 or 3 months, and then eventually the banks say to their lawyer, okay, foreclose. Another month, the lawyer's in court. Well, that's 4 months. And then in court, they say to the judge that the bank wants to foreclose, and the judge gives 6 months. Or it could be longer, it could be shorter, but generally it was about 6 months. A 6-month cushion when the owner of the property could pay before the foreclosure could go through. Well, the 4 months plus the 6 months means it's already 10 months of compound interest, all right, that's being built up and eating away at the equity that the person has in the property. As a consequence, it's better sometimes, depending upon the circumstances, to quit claim. If you have no opportunity of getting a job, if there's no other funding available, you're going to lose the property, better to get rid of it early. So at the end of the 6 months, the bank contacts their lawyer and says, okay, go into court and foreclose on the property. Well, it's going to be 11 months or 12 months before the foreclosure actually takes place, and all that time, whatever you owe on the mortgage in the way of principal and the missed payments are added and interest is compounding, you can wind up with a situation where any equity you have in the property has been eaten away very quickly. All right, so concepts that you want to know is mortgagor, mortgagee, right of redemption, equity, acceleration clause, and foreclosure. Now, a second mortgage you should know about as well. You can have third mortgages, you can have fourth mortgages. Generally, pardon me, most people don't, because there's the banks don't give mortgages when the equity runs out on the property. Okay, so basically that's mortgages in a nutshell. What we're going to do is we're going to talk now about the steps in a transfer of land. In other words, you're purchasing the property, what sort of documents are necessary. Once we're finished that, then we're going to look at ways that a business can raise capital. The old textbook used to look at it from the lender's point of view. What can a lender do to secure loans made to debtors? Most of us are going to be in the debtor's position. We're going to have businesses, and we have to generate investment, and so we'll talk about how to do that. But first, we will look at the steps in a steps in a conveyance, and there's about 10 or 11 documents that are involved in all that. So it's quite complex, and we'll get into that. All right, I just realized that there's really two benefits of online learning. The first is, of course, that you can never miss a lecture. I mean, I post my videos, and you can look at them when you have an opportunity. It's not like if you miss a class, oh darn, I've missed a lecture, now I'm going to get notes from somebody. So you can, do that. Actually, another benefit is you can watch the lectures, and if you miss something, you can back it up and take another look at it. And the third benefit is that I used to have a package of material which I'd put together and I would sell in the bookstore. Not that I made any money. The money would cover the cost of printing only. But then you had to buy this in order for me to talk about certain articles and documents and things. But it's awkward to do that because the print shop only works part-time, the bookstore only works part-time. You'd actually buy your textbook before the term starts, and then you find out afterwards you have to buy something else. So rather than put it online, sell it through the bookstore, I'm just going to copy them and then put them into the eLearn, and you can save money. Hey, everybody's up for that, right? So now we're going to look at the steps in a transaction to purchase property. Whether it's you're buying a house, or you're buying a lot, or you're buying a business that has premises, pretty much all the same. There is a standard form contract put out by the real estate board called a contract of purchase and sale. The purchaser puts in their information and how much they're willing to pay, and the deposit to be increased by a certain amount on closing. Then they sign. It goes to the vendor, and the vendor looks at it. Yeah, I agree with that. And they sign. It has all the dates in it. The dates for deposits, dates for removing subject clauses, and the date for closing and things like that. So that is the very first document. You negotiate the purchase of the property. One of the things that sometimes happens, and we talked about this when we did conditions precedent, is that the vendor will put in, the purchaser will put in a condition precedent saying this purchase is conditional upon my getting a mortgage from the bank at a certain rate, and this is put on, a purchase and sale addendum. This one says the vendor to pay 1/2 the GST because it was a new property, and so the vendor has to pay GST, but the vendor's only going to pay half the GST, and the purchaser's going to pay half. The vendor warrants that the house against all major and minor structural defects. Okay, that's subject clause. The next document is actually very similar to that. Once you have these subject clauses in there, there will generally be another addendum attached to the purchase and sale agreement whereby the parties agree that a certain condition precedent or subject clause is removed. Okay, so then once those documents are done, it becomes a binding contract, and the only thing that has to be done now is payment made and transfer given. Well, before you actually want to buy the property, you want to make sure that the house on the property is actually within the boundaries of the property, and that there isn't an overhang onto the next property or something like that. So you always want to get a certificate of title. And sometimes the vendor will have a certificate of title that's fairly recent, and you can assume that the house hasn't been moved 3 feet or something, and so you can use that. Sometimes you actually have to get in a land surveyor to do the certificate of title. So this one is for a piece of property on Gravely Street in Vancouver, and it shows that here's the lot, and there's the house within the lot. And actually there's the garage at the back, and you can use that to make sure that there's no places where the structures are actually over the property line, but also there may be a setback required by the government, and you want to make sure you're okay on that. Okay, then the real estate agent's job is done. Then comes the lawyer, and the lawyer has to do a Form A transfer. This is the document that transfers ownership from the vendor to the purchaser. And in this one, which you'll see because I'll post it online, there's a parcel identifier number, which is now a code that you can just put in to get information about the property. There's the fair market value, and there's the consideration being paid. Who is the transferor, the person transferring, what's being transferred, a fee simple, and then who are the transferees. And these people are buying, you'll be able to see it in joint tenancy. Then the vendor signs at the bottom, and the vendor's signature has to be witnessed by a either a notary public or a solicitor. That's the Form A transfer that actually does the conveyance of the house. It says market value and consideration. That's important because it may be a situation where one person is trying to give a gift to the other party, and so the consideration being received might be far less than the actual value of the property. One reason for that is I can, for example, transfer title to my house to my children without generating this thing we'll find out about called the property transfer tax. And so what they want to do is they want to know what the real value of the property is, and then the fact that there's consideration being paid is less. It twigs the government to look further into the transaction to make sure everything is copacetic. Sometimes you'll see $1 and love and affection. Okay, that means it's generally a transfer from a parent to a child, or from a child to a parent, or whatever. Okay, then there's this thing called a statement of adjustments that has to be done for both the purchaser and the vendor. And it's just really an accounting document. Here's a purchaser statement of adjustments and a vendor's statement of adjustments. And I've tried to block out the people involved, and I put in here the vendor is Harold Frumstetter, and the purchaser is Dagmar Francine and Beatrice Baumlinger. Those are definitely fictitious names. The vendor statement of adjustments, I didn't bother doing that, I just blacked them out. But the whole idea is that there are certain amounts of money which must be accounted for on these. So in the purchaser's statement of adjustments, this is what the purchaser is actually paying. Okay, this is really important to the purchaser to make sure they have their money organized and all their ducks in a row so that they can complete the transaction. On one side there's the purchase price, and then on the other side is the down payment that they may have already made in order to secure the transaction. So it has to be deducted from the purchase price. Then this one, there's adjustment for property taxes. And why that would occur is the fact that the property taxes are payable at the beginning of July, I think it is. Don't ask me why, you'd have to ask the government. Well, if I'm selling the house in March, I've occupied the house January, February, March, but the taxes are paid in July. So the purchaser is going to wind up paying the taxes for the whole year, but didn't own the house for the whole year. He only owned it at the beginning of April. So the vendor will have to compensate the purchaser for 3 months. Okay, but if the transaction occurs in October, then that means that the vendor has been there for January, February, March, April, May, June, July, October. June, July, September, October, 9 months. So, and will have already paid the taxes, but they'll have paid the taxes for the whole year. So why should the vendor pay taxes for 12 months when 3 months of that, 2 months, November and December, the purchaser is going to own it? So there has to be an adjustment for taxes. Okay. On this one, there was the Minister of Finance property transfer tax. The NDP government brought in another, if you own property, you must be rich, therefore you should pay taxes, sort of legislation. And they said that everybody that owns property that sells it, or that buys it, is going to have to pay this property transfer tax. And so consequently, the purchaser who's buying it has to pay this tax, which is, and it's in here, and we'll get to it a little later on because I can't remember. It might have changed. It was like 2% on the first $100,000 plus 1% of everything over that, and then they brought in a new rule that if you're buying a house and it's worth even more than that, like over $5 million, then you had to pay extra on that. So it's a graduated tax, okay? So the purchaser has to know what the taxes that property transfer taxes are going to pay. In this particular case, it was nil because it happened to be a first-time buyer and they were exempt. Then there's my legal bill and disbursements, okay? I want to make sure I get paid for that. So that's something the purchaser has to pay for. Okay, so there's all the things the purchasers have to pay for, but they didn't have the money to buy the place outright, so they needed a mortgage. So they get mortgage proceeds. Well, they don't have to pay that. So the whatever they paid in the down payment plus the mortgage gets deducted from everything that they have to pay, and then there is the balance necessary to complete the transaction. And that's the money that has to be given to the lawyer in his or her trust account before the date of the transaction. The vendor's statement of adjustments, the vendor is going to get this amount of money for the property, but they've already received a deposit, so it has to be taken off that, right? And then they have to pay their real estate agent. Okay, so that gets taken off of that. And then there was a purchaser's credit here. There was some like a garage that could be taken away, or like a canopy thing in this. So they wanted to buy it, and the vendor said, okay, sure, we'll sell it to you. So they had to pay for that extra. And then there's an adjustment for the property taxes, okay? And so those are all the things that the vendor's going to pay. No, all those things that's going to come off. And then over here is the what they were supposed to get less all these other things, okay? So it's just the calculation for the vendor so that they know exactly what's coming into them. There was an adjustment for utilities here too, okay? So they'd already paid the utilities for the year, which I think were paid on every 2 months or something. And so they'd already paid some utilities, even though the buyer was going to get the benefit of it, so the utilities had to be given to the vendor, okay? So those are the statement of adjustments, the financing of the transaction. Not quite as straightforward as you think. Okay, then we do get into the property transfer tax, and there's a form that you fill out, and I mean, it looks like this, big deal. You can look at it when you have an opportunity, but what it does is it says who the purchasers are, who the vendors are, what the effective date of the transaction is it vacant land, is it residential, what the property transfer number is off the land title office, and then there's some other material that you don't have to worry about. But then you get down to the part where they actually calculate what the property transfer tax will be. And this was a straightforward transaction, so it was just 2% of the first $100,000 and then 1% of the amount over that. If you don't have that and it's not paid on the day of the transaction does not go through. You want a GST exempt certificate if the property is not new. What that means is that the person swears that they've lived in the house for over a year. The vendor says that, and so there's no GST applicable. Okay, if it's a brand new house and it's done as a developer, or if a vendor has a builder build it and then sells it before 1 year's up, GST will be paid by the purchaser. Then there's also another document, okay, and it's a statutory declaration with respect to the Income Tax Act. And I haven't taken out a couple of the names here. I better make sure I do that before I let you see that. It says that these people are residents of Canada within the meaning of the Income Tax Act, the vendors, and therefore they will be paying their taxes, any taxes owing when they pay their taxes for the year. If the vendor is not a Canadian, it may be that they're going to take the money out of the country, and what the tax department says is, okay, if they have to pay any tax on that, or if their other transactions and they're dealing in Canada generate tax owing, they have to pay all that. And if they don't pay that and they take the money out of the country, then the tax department goes back to the purchaser and says to the purchaser, aha, you shouldn't have given them all that money, therefore you're going to have to pay the taxes. So that means when you're going through a transaction, there has to be this form that says, I am a non-resident of Canada within the meaning of the Income Tax Act. Or I am not a non-resident. I am not a non-resident. So in other words, I'm a resident of Canada within the meaning of the Income Tax Act, so no holdback has to be kept. If, however, the person is a non-resident and will be taking the money out of the country, there has to be a holdback. So if I was doing the transaction for the purchaser, I would send the money to the vendor's lawyer, less a certain amount of money, which I hold in my trust account. So the transaction is complete. My clients own the property. It's just the vendor is not going to get all the money until the vendor goes to the government of Canada and says, here's all my tax information, and then the government of Canada will say, okay, there is tax owing, okay, and then the vendor has to pay that. When the vendor pays that, this money is released, okay, that I'm holding. If the person leaves the country and doesn't pay the taxes, and it turns out that there's $6 million in taxes owing, and I'm only holding back $85,000, my client's $85,000 will go to the government, and the government can try to get the rest. Okay, but I just have to have that statutory holdback to ensure that some portion of the taxes will be paid for my client. Okay. If my client needs a mortgage, then I have to prepare a mortgage, and it will outline identify the property. It'll say who the lender is. This was a Scotiabank. It says who the mortgagor is. That was my client's, and it gives information about the mortgage. Okay. And this gets filed at the Land Title Office. It's called a Form B mortgage. And the bank signs it and provides it to me, and I register it along with the purchase, the Form A purchase. Okay, so there may be a Schedule E, which is additional clauses to the mortgage document. In this particular case, there was, but not always. Okay, so Form A and a Form B for sure. Sometimes a Form E. The transaction is complete. Those documents get filed at the Land Title Office. Once the transaction has been completed and registered in the Land Title Office in British Columbia, then I, on behalf of my client, can apply to get a certificate of title. I do this with a reporting letter to my client to show them that yes, they bought the property, and they are now the fee simple owners, and it may be that there is a mortgage on there because the mortgage that was registered against the property by the vendor is still on there, because I get money into my trust account, the vendor's lawyer gets money into his trust account, and then he pays off the mortgage. But it takes a while for all that to take place. The vendor's lawyer has to send the money to the bank. The bank has to make sure that the mortgage is paid off. Then the bank provides a discharge of mortgage. The discharge of mortgage goes to the lawyer. The lawyer files it with the land title office, and then eventually the land title office says, okay, that mortgage is gone, and it won't show on title. But what happens here is I provide a certificate of title, or a state of title certificate to my client that shows that they own it, subject to that mortgage, but then I have the proof that the mortgage has been paid. Eventually we'll get what's called clean title. Now, those are all the documents in a transaction, with the exception of one possible document, and that is every once in a while you're required as a purchaser to have an environmental impact assessment done, and then you have to go to the provincial government to find out what's necessary. Quite often in commercial transactions, for example, they want to make sure that the lot being sold was not a former gas station, or there may be pollution in the soil. Okay, so they have to do an environmental impact study. Or if you are buying a piece of property and there's a creek bed at the back of it or something, they want to have an environmental impact study to find out if when you build your house there won't be seepage from the bank into the water, that sort of thing. Okay, so those are all the transactions in a purchase and sale of a property, and I have in the past on the exam said list 10 of, I think there's 11 common documents in a real estate transaction. Because this is an open book exam, I would be expecting you to do more than just list, so I would probably say list and explain the reason for the 10 of these documents. Okay, so that concludes land law, and I will post the land video, land law video, and then I'll post the mortgage on land video along with this material on the purchase and sale of a property, and that will conclude that portion of the course. And the next topic, as I mentioned, will be secured transactions, how a business person can go about raising capital. And raising capital means generally giving some sort of security to the bank or other lenders. One of those types of securities, of course, is a mortgage, and we've just gone through that. And it would be a Form B mortgage that would be registered in order to get those funds. Okay, that's all for now.